What's up, everybody? My name is Joshua Stanton. I'm the Mortgage Dude. And today I am excited to show you a simulation of my favorite mortgage product in America. It's the All-in-One Loan by CMG Financial. And there's a ton of reasons why I love this mortgage, but it is truly mortgage freedom. It's the best mortgage that I've ever seen on the residential level here in the United States. So let me tell you a little bit about it, and then I'll share my screen and do a simulation. So this mortgage is somewhat of a mortgage and banking account in one. Now, that's somewhat of a paradigm shift for people, but I can tell you why it's so awesome. It's going to simplify your life, and I think you'll see that through this simulation. So the first part of this mortgage is we wanted to come up with a way to accelerate people's pay down, right? So they could pay off their mortgage faster. People get into a refinance cycle. Most people don't pay off their mortgage in 30 years. It's more like 35 or 40 or more, because you have all of these mortgage companies coming out there and saying, hey, interest rates fell. You can refinance and save 150 bucks a month. I don't care. I don't want to save 150. I want to save tons of money, and I want to save tons of time. I'm into finding the most efficient way to use my money and then using that method, right? So all-in-one loan, boom, here you go. So number one, it's a mortgage accelerator. You pay off your loan extremely fast. Second part of it is the money that you put in and equity that you have is liquid. So if I put $5,000 in today, tomorrow, that $5,000 is available to me, and I can take it right back out if I need it for anything. So unlike a normal conventional fixed rate mortgage product where you give the bank your money and then they use it for whatever they invest in and it's gone to you, with this mortgage you can actually use your money whenever you want. You can take it back just like a checking account. No fees, no nothing. You do that with a check or debit card. There's multiple ways to use this and to move money around. It functions just like a checking account. So those two things are kind of a lot of information that I just threw at you, but I'm hoping that my simulation will help clear everything up. So I'm going to show you a simulation of Mr. and Mrs. Smith. These are clients of mine that closed last month. For this simulation, I'm just going to show a quick payoff. They didn't have any ideas of future spending. They just wanted to pay off their mortgage extremely quickly and then just start pumping money into retirement, which is an awesome idea. So my financial advisor told them, hey, you got to talk to Joshua Stanton, this mortgage dude. He's going to show you how to pay off your home extremely fast and efficient. Nobody else does it like him. So they called me and we did it, and they're extremely happy. So here we go. Estimated home value. Their home value came out to $800,000. Their loan balance, $650,000. 30-year fixed mortgage, interest rate 4%. This is their primary residence. You can do the all-in-one loan for a primary residence, a second home, or an investment property. This is their primary residence. So we're looking at the principal and interest payment for a $650,000 loan, 4%, $3,103.20. We're only looking at principal and interest for this. We're not looking at escrow right now because escrow is separate with the all-in-one loan. You pay for your taxes and your homeowner's insurance on your own. The servicer does not pay for those for you. It's because this product is all about keeping your money in your pocket, keeping your money free and liquid. So until bill's due, it stays in your pocket. You get to do whatever you want with it, maybe funneling it through the all-in-one loan and saving interest. So making extra payments? No, we're not going to put in any extra payments. Most people don't. Why? Because if you make extra payments to the bank, that money goes to them and you might pay off your mortgage slightly faster. But fact of the matter is, that's a lost opportunity cost of your money for you. You give it to the bank. Now you have no more opportunity to go and invest it in other ways. So most people don't do it. So we're going to go to this next page. This is the deposits page where I ask customers how much income they have. And I want to know what their net income is. We want to keep all of their, or as much of their net income as possible, liquid for them and working for them 24/7. No dead money. Dead money is money that's in a savings account that's just sitting there, rainy day money. It's not earning you anything. In fact, right now with inflation as high as it is, that money is sitting there devaluing. So I'm going to show you how to use that money and make money from it. So Mr. and Mrs. Smith told me they make $18,000 a month. They do well. They make a lot of money. That's after taxes. Monthly. We're going to skip the one-time deposit because I want to show you guys the most simplistic version of this. Okay, so on this next page, the spending page, I talked to Mr. and Mrs. Smith about what their spending habits are. We wanted to talk about their spending habits on a monthly basis, and this is a big part of this product. It's very important. There are 3 things that you need to qualify for this loan. Number 1, you have to have at least 700 credit score for just about every state. Second thing is you have to cash flow monthly in order for this thing to work, because your extra cash flow is going to be funneling through this thing, effectively paying down your mortgage super quick, right? And saving you a ton of time and money and interest. And then the third thing is underwriting is going to ask to see some assets. So for questions on those things, get in touch with me directly. So here we go with this spending page. We got their $18,000 a month. We got the mortgage that comes out of it, the $3,103.20, and then estimated taxes and insurance. I'm going to change that because that's not accurate. Their taxes and homeowners insurance together every month are about $450. That comes out. And then their other expenses. So we're going to manipulate this a little bit. And this is important to talk about. I talk to people about what their lifestyle looks like, their financial lifestyle. It might be a somewhat of a difficult question to answer for month in and month out, but I want to talk about your average monthly expenses. And what I mean by that is, you pay for your car, you pay for your credit card, you pay for trips, you pay for your life insurance policies, whatever you have, right, in your lifestyle. Average all that out. We'll figure that out together. And for Mr. and Mrs. Smith, they were spending about $9,000 a month, $9,000 and change on the other stuff after their mortgage, right? So about 30% of their income. So that meant that they had $5,400 left over every month. And before they knew about the all-in-one loan, they were just pushing that money into a money market account because they were earning about 2% on that money, and it was liquid. They could go and take any portion out whenever they wanted, and they thought that that was awesome. And that was okay, but they didn't know about this. I'm going to show them how to make that $5,400 work for them a lot quicker. Okay, so we're on the results page. I'm going to make a couple of changes, and then I'm going to come back. So let's go to rates and assumptions, and I'm going to talk about interest rate with this loan. So primary residence, 1 month adjustable. This is an adjustable rate mortgage that recasts. That's really important to know. Not all adjustable rate mortgages recast. This is one that does. This recasts every 24 hours, which is extremely powerful because if I put $5,000 into the loan today, tonight at midnight, that money's going to hit the loan and the balance is going to drop by $5,000. And then tomorrow I'm going to be paying interest on that new lower value. So again, snowball effect, paying down the mortgage. If you take money out, the balance goes back up by whatever you take out, right? But that's fair. You're paying things down, you're taking it out. If you see an asset that you think is going to be lucrative, you can go for it. It's your money. You get to drive this vehicle. So getting back to interest rate, I'm going to change this margin because the bank charges 3.5%. And the index right now is at 1.130%. The index and the margin make up the interest rate. The index is the CMT index. That changes monthly. The margin does not. It's fixed at 3.5%. The fully indexed rate that I'm selling right now is 4.630% this month. Changes every month though. The floor rate is 3.75, meaning the rate can go down. It can't go below 3.75. There's a max rate. It can, in this scenario, it can't go above 10.630. What we wanted to do with this simulator was build something that we thought was fair and hopefully worst case scenario for people. So this interest rate environment is important to talk about. It says increase to average. We inputted the 25 years of historical data movement of the CMT index. So that's what we're going to be showing here. So as we look at that, the average rate used for this scenario is 5.472%. And I'll show you why. So let's look at the graph. Expand graph. So this is the last 25 years of historical movement with the CMT. So you can see it moves up and down pretty dramatically, right? Mostly it's been down. It's been good for people, and I think it's going to continue that way. But you can see the 30-year fixed mortgage, you know, kind of just working along. It's been working slowly down for the last 25 years as things have kind of not been amazing. But I like to show this graph because it illustrates the movement of this interest rate. It goes up and down. I'm not worried about interest rate though at all, and I'll tell you why. Because this mortgage recasts. And I know I keep on bringing that up, but if you put money into it and you're just paying your balance down really, really quick and your interest is connected to that, well, I don't care if I have an 8% interest rate if I'm going to pay off my home in 10 years and save a bunch of money. Interest rate is not a thing with this loan product, and it's hard for people to get over. Again, it's a paradigm shift, but it's more about putting into it and making it work in an intelligent way. If you do that, if you work this thing properly, you're going to save a lot of time and money, and interest rate's not going to matter to you at all. So let's go back out of here. Return to rates. And I'm happy to talk to anybody about the interest rates if you want to get in touch with me. So in this scenario with Mr. and Mrs. Smith, they're going to pay off their all-in-one loan in 7.8 years instead of 30 years. That's insane. They didn't do anything different. They're not going to live their lifestyle differently. They're just going to do the exact same things they've always been doing. They've been having a lot of fun with their family, traveling, spending money, making good money too. But at the end of the day, they cash flow positive. And again, that's very important. You have to cash flow positive to make this thing work. You get out of it what you put into it. So if we look at some of the details here, this is kind of exciting. 7.8 years to pay off. So right there, that's awesome. Total saved, $316,795 or that around, you know, that's what they're going to save over the life of this loan compared to the 30-year fixed loan. Now that's enormous, right? That's huge amounts of money, but that's not even the most impressive part of this whole thing, right? If you pay off your home loan extremely fast, then what are you going to do with your money after that debt is gone? How are you going to multiply your money? That's the opportunity that gets me super excited with this loan product, guys, because it's all about opportunity and liquidity. Keep my money in my pocket and keep it liquid and tell me that I can do whatever I want with my money instead of giving it to another entity to control. That's what this is all about. This is amazing, right? And this is what they're doing. So they're saving a lot of time and money, right? Let's look at this pay down summary really quick. This is fun. So there's a couple things on here that I really like to illustrate. The all-in-one loan over here, the traditional mortgage over here. So the break-even average rate. So this is funny. The all-in-one loan would have to average 10.995% in order to break even with this 30-year mortgage that is at 4%. So what's a better interest rate, right? The 5 point something that this one is simulating, or 4%. It's apples and oranges. It just depends on how interest is calculated, okay? The comparison effective APR, 1.435%. That's cool. That's basically saying that the 30-year fixed would have to be 1.435% in order to give you the same amount of savings as this all-in-one loan. You're not going to find an interest rate like that. I've never seen one anyways. Let's take a look at a couple more things. So I'm going to get nerdy with some numbers real fast with you. So with this pay down table, it takes you month by month, and you can see the principal pay down. So I'm just going to go to 12 months. Okay, so after 1 year, Mr. and Mrs. Smith will have paid down their mortgage and have $74,000 and change available. They've paid it down by that amount, and it's still available, because remember, any money you put into this while you have it open for most of the time is available, so you can put it in, you can take it back, right? Invest however you want. With the 30-year fixed loan, you know, you've only paid down $11,000, so pretty big difference? I'd say so. Let's return to the summary. Look at one more thing. Pay down graph is extremely important. This is a 30-year mortgage, you guys. So there is an end game, right? And we want people to pay off their mortgage in an intelligent way and cheap and fast, so you can get on with your life, right? But you have to pay off the mortgage. So we want you to accelerate that with this. People get psyched when they get into this and they start seeing their balance drop by huge amounts every single month. It does, you know, convince people to start finding money that's not performing in other realms and take that money and put it into this, because this just simply performs, and you never know what's going to happen in the stock market or other things, you know. But this works. So let's look at the graph. This black line shows Mr. and Mrs. Smith's extremely fast pay down. They get to zero there, and they can do one of two things. They can close out the loan and say, thank you very much, see you later. Or they can keep the loan open at a zero balance. They don't owe anything, no interest or anything like that. They do have to pay a one-time annual fee of $60 in order to keep the line open. Most clients think that that's pretty reasonable. So they'll keep it open because, look, you've got access to all this equity whenever you want. This blue line, right? This is very important because, again, this is a 30-year loan. You have access to your equity, all of the equity up to your credit limit that you'll qualify for, and get in touch with me for more information about that. Up to your credit limit for the first 10 years, right? And then the amount that you can borrow against your equity goes downwards for the last 20 years by 1/240th per month, because there's 240 months in a year, in 20 years. So once you get done with 30 years, you're done. Although you could refinance your house and you know, kind of start over on this and still have access to your equity if you wanted to. But I guess the point of this graph, there's a couple. I wanted to show you guys, you can borrow in this area right here. You can borrow money if you need to for anything you want. Investments, you can buy a bunch of houses, use your own money to buy houses. That's a smart way to do it, instead of going to a bank or a third party, hard money lender, something like that. But you can borrow that money, right? So get in touch with me for more information about that. I'm going to move forward. And we're going to go back out to the results page. Cool. So this is Mr. and Mrs. Smith's simulation. Everybody's is different. I love to show this thing. So get in touch with me directly. I'm more than happy to go through a simulation with you. We can manipulate it however you want. I'm happy to show you exactly how this thing works and answer any questions that you have and see if it's right for you. And if it is, I'm super excited for you because, yeah, I'm living proof that this thing is amazing, and it is a financial game changer. No strings attached. It's a very simple product to get into once you get down the road with the process. and I'm with you every step of the way. So get in touch with me. I'll show you more. It's Joshua Stanton, your mortgage dude. Thanks a lot.